Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Capital Allocation for Risk Mitigation. Capital allocation for risk mitigation is a cornerstone of effective risk management, underpinning the stability and sustainability of financial institutions and corporations. This process involves the strategic distribution of financial resources to minimize potential risks while maximizing returns. The concept is rooted in the belief that not all risks are equal. Therefore, allocating capital in a manner that addresses the most significant threats can safeguard an organization's financial health and ensure long-term viability. One of the primary frameworks used in capital allocation for risk mitigation is the risk-based capital model. This approach assesses the amount of capital that a firm needs to sustain its operations given its risk profile. The RBC model takes into account various types of risks, including credit risk, market risk, operational risk, and liquidity risk. By quantifying these risks, the model helps organizations determine the appropriate capital reserves required to absorb potential losses. Credit risk, the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations, is a critical factor in capital allocation. Financial institutions often use credit ratings and historical default data to estimate the probability of default and potential loss given default. For example, during the 2008 financial crisis, many banks faced significant losses due to high exposure to subprime mortgages. Proper capital allocation could have mitigated these losses by requiring higher capital reserves against high-risk loans. Market risk, which refers to the potential for losses due to changes in market prices, is another essential consideration. This type of risk can be influenced by factors such as interest rate fluctuations, currency exchange rates, and commodity prices. Financial institutions use various models, such as value at risk, to estimate the potential loss in value of a portfolio over a given time frame under normal market conditions. VR helps in determining the amount of capital needed to cover potential losses, ensuring that organizations can withstand adverse market movements. Operational risk, defined as the risk of loss resulting from inadequate or failed internal processes, people, or systems, also plays a significant role in capital allocation. This type of risk is often more challenging to quantify due to its intangible nature. However, organizations can use historical loss data, scenario analysis, and key risk indicators to estimate potential operational losses. For instance, a major operational risk event was the collapse of Barings Bank in 1995 due to unauthorized trading activities by a single employee. Effective capital allocation for operational risk could involve setting aside capital reserves to cover potential losses from such unforeseen events. Liquidity risk, the risk that an organization will not be able to meet its short-term financial obligations, requires careful capital planning. Adequate liquidity ensures that a firm can continue its operations despite unexpected cash flow disruptions. Stress testing and liquidity coverage ratios are tools that organizations use to assess their liquidity risk. During the 2008 financial crisis, many institutions faced liquidity challenges, highlighting the importance of maintaining sufficient liquid assets. Effective capital allocation for liquidity risk involves holding a buffer of high-quality liquid assets to cover potential cash outflows. A practical example of capital allocation for risk mitigation can be observed in the insurance industry. Insurers use risk-based capital requirements to ensure they have enough capital to cover potential claims. These requirements are based on the insurer's risk profile, including underwriting risk, investment risk, and catastrophe risk. By maintaining sufficient capital reserves, insurers can protect policyholders and maintain financial stability even in the face of significant claims events, such as natural disasters or pandemics. Risk capital attribution, a related concept, involves assigning capital to different business units or projects based on their risk contribution. This process ensures that capital is allocated efficiently and that each unit or project is held accountable for its risk-taking activities. For example, a bank may allocate more capital to its trading desk, which has higher market risk, compared to its retail banking division, which has lower credit risk. This approach not only promotes prudent risk management, but also encourages better decision-making by aligning risk-taking with capital requirements. It is important to note that capital allocation for risk mitigation is not a one-time activity, but an ongoing process. Organizations must continuously monitor their risk exposures and adjust their capital allocations as needed. This dynamic approach allows firms to respond to changing market conditions and emerging risks effectively. For instance, during the COVID-19 pandemic, many businesses had to reassess their risk profiles and reallocate capital to address new challenges, such as supply chain disruptions and increased cyber threats. Moreover, regulatory requirements play a significant role in shaping capital allocation practices. Regulatory bodies, such as the Basel Committee on Banking Supervision, establish capital adequacy standards to ensure that financial institutions maintain sufficient capital to cover their risks. The Basel III framework, for example, introduced stricter capital requirements and new liquidity standards to enhance the resilience of the banking sector. Compliance with these regulations ensures that institutions are better prepared to absorb losses and continue their operations during periods of financial stress. In conclusion, capital allocation for risk mitigation is a critical element of effective risk management. By strategically distributing financial resources to address various types of risks, organizations can protect their financial health and ensure long-term sustainability. The use of models such as the risk-based capital framework, along with tools like VR and stress testing, allows firms to quantify their risk exposures and determine appropriate capital reserves. Real-world examples, such as the 2008 financial crisis and the COVID-19 pandemic, underscore the importance of continuous monitoring and dynamic capital allocation. Furthermore, regulatory requirements ensure that institutions maintain adequate capital to cover their risks, contributing to the stability of the financial system. By adopting a comprehensive and proactive approach to capital allocation, organizations can mitigate potential losses and navigate the complexities of the modern risk landscape. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.